So let's look at the cost, figuring out the cost of plant assets, because there's a lot that goes into that. Rizzio Company purchases a machine for $12,500, and the terms were $210, net $60, freight on board, shipping point. Now, Rizzio paid within a discount period, and so they were able to take a $250 discount. Transportation cost was $360. That was paid by Rizzio. The machine requires mounting and power connections that cost $895. Another $475 was paid to assemble the machine and $40 for materials used to get it into operation. Upon installation, the machine was damaged and $180 worth of repairs were made. And so we're going to compute the cost for this machine. The invoice price of the machine, we said, was $12,500, but we are going to have to deduct the cash discount because we paid it within the 10 days. Okay, so $250, so we'll subtract that. So the net price of the machine is $12,250. And then we have the freight to get it to us was $360. The mounting and the power connections were $895 to have those installed. To have it assembled at our site is another $475. The materials used in adjusting or used to get the machine in operation was $40. And so the total machine cost is $14,020. So remember that anything involving the machine, the freight, getting it, which is getting it to your place, anything that is needed to make it operable initially is going to be included as part of the price. So now, how do we go about recording the cost of the asset an asset? So Kala Manufacturing purchases land for $390,000 as part of their plan to build a new plant. The company pays $33,500 to tear down an old building on the lot and $447,000 to fill and level the lot. It also pays construction cost of $1,452,200 for the new building and $87,800 for lighting and paving a parking area. And so we're going to prepare a single journal entry that reflects all of the costs incurred by Kala, all of which were paid in cash. So we would debit land improvements, and building. And so land would be the $390,000, which is the initial price of the land, plus $33,500, which is the cost to tear down the building that already exists there. And then also, I think there's a typo, it should be $47,000 in order to fill and level the land. So that you would debit that. Then you have land improvements of $87,800, and that is for your parking lot and lighting. And then the building is $1,452,200. And then we would just, of course, credit cash for the total of these. So the lump sum purchase of assets. So Rodriguez Company pays $395,380 for real estate with land improvements, and a building. The land was appraised at $157,040. Land improvements appraised at $58,890, and the building appraised for $176,670. So we'll allocate the total cost among these three assets. So again, you have the appraised values, and so then based upon the percentage of the total. So land makes up 40%, the land improvements 15%, and the building 45%. That equals 100% of $392,600. So then you can multiply 40% by the acquisition cost total. We know then that the land was $158,152. That's what it cost. The land improvements, $59,307, and the building for $177,921. So for $395,380. So again, you see here that this is how much they paid. $395,380. That's what they paid, but then everything else here is what it actually is worth. So they obviously paid a little bit more than what it was worth. And so then to prepare the journal entry is we have land, $158,152 debit. Again, that would be based on the apportioned cost. Land improvements, so $395,380. Again, multiply by 15% is $59,307. And then buildings, and then cash would just be the total, would be a credit for the total for those. About how depreciation works. So Ramirez Company installs a computerized manufacturing machine in its factory at the beginning of the year for a cost of $43,500. The machine's useful life is estimated at 10 years or 385,000 units of product with a $5,000 salvage value. During its second year, the machine produces 32,500 units of product. And so we'll determine the second year depreciation under the straight line method. So again, you have the cost minus the salvage value divided by the number of years of useful estimated life. So the cost minus the salvage, the machine cost us $43,500. We said it had a $5,000 salvage value. So we'll divide that over 10 years. And so we see here that the depreciation per year is $3,850. So you can create a table like this. So year one, the beginning book value was $43,500 because that's what the cost of the machine was. And then subtract the annual depreciation, $3,850. You get an ending book value of $39,650. So then in year two, so they just want to know how much the depreciation is. Well, we see that it's going to be the same each year. So because you do this straight line, it's going, and the way it worked out, it's going to be the same each year, how much the depreciation is. So this is another example. So the numbers are going to be slightly different. So you have the beginning, the cost here is the beginning book value is the cost, and then the ending book value is the salvage value. Now, again, numbers are going to be different because this is a different example of the same thing, but I just want to show you that you're going to begin in year one, the beginning book value is going to be the cost, and then the ending book value then becomes the beginning book value for year two, and so on and so forth. And then at the end, the ending book value at the end of year 10 would be whatever the ending book value was. And so the example that we looked at previous, that was 5,000. So again, looking at this, Ramirez Company installs the same thing, computerized manufacturing machine in its factory at the beginning of the year at a cost of $43,500. The machine's useful life, as we said, same thing, estimated at 10 years or 385,000 units of product with a $5,000 salvage value. And in the second year, it produced 32,500 units. And so determine the second year depreciation unit using the units of production method, which there is this on the homework. So again, you have to figure out then how much per unit the depreciation would be. So you have, again, the cost minus the salvage divided by the estimated useful life. But this time, rather than years, we're going to use the number of units total that will be produced over the machine's life. So again, 43,500 minus 5,000 divided by the total number of estimated units, 385,000. So we see here 38,500. That's the amount that we're going to depreciate over the 10 years divided by the number of units that the machine will produce, which is 385,000. So that works out to 10 cents of depreciation expense per unit that is produced. And so then what you can do is take 10 cents, multiply by 32,500 units that were produced in that year, in year 2. You come out with 3,250. And double declining balance, again, the same kind of thing. But again, you're going to have, because it's double, it would be 200% times the beginning book value over 10 years. And an depreciation expense would then be 20% of the book value for each year. And we see in year 1, we see 43,500 multiplied by 20% is going to be 8,700. And so then the ending leaves an ending book value of 34,800. And so we start with that, multiply. So then in year 2, it's 6,960. That's what we're looking for. But you can see how that works out. In year 10, we see here that if we multiply by 20%, we're going to end up depreciating this down to lower than the book value. So then we would have to, we see that. So 5,838, again, minus 20% of that would equal 4,671, which is less than the scrap value. So we would have to depreciate it by $838. That brings us to our 5,000, and that's something that's specific then to year 10, because it's the double declining balance method. What it's allowing you to do is it's allowing you to depreciate more in the early years and then less in the following years, rather than like with straight line where it's going to be the same amount no matter what, or depreciate, or the units where it would be based on the number of units that are produced. Because 9 will explain how this affects on the income. Troy Enterprises pays $238,400 for equipment that will last 5 years and have a $43,600 salvage value. By using the equipment in its operation for 5 years, the company expects to earn $88,500 annually after deducting all expenses except depreciation. So we'll prepare a table showing income before depreciation, depreciation expense, and net pre-tax income for each year and for the total 5-year period, assuming straight line depreciation is used. And we got to figure out how much for each year they're going to depreciate. So again, you take the cost minus the salvage is 194,800. That's the amount that you'll depreciate divided by 5 years of useful life. So you'll depreciate 38,960 per year for 5 years. So they're figuring that in each year, they're going to have income before depreciation of 88,500 each year. So we know it's straight line, so we're going to depreciate the same amount each year. We figured that out up here. So then their pre-tax income, net income, would be for each year would be 49,540. And then we have, again, just these other ones are doing the same thing with the income. It's just based on a different method so we can see. So if they were to use, let's say, a double declining balance, we'll see that that makes a difference for their net income. So again, same information. So again, you'd figure out 200% times the beginning book value over 5 years. So the beginning book value is 238,400. Depreciation rate's 40%. So the end depreciation is 95,360. So that leaves an ending book value of 143,040. So you start with that, multiply. So and depreciation, again, more in the beginning, and then it gets down to less. Now, in year 4, we notice that 51,490 minus 20,000, because again, that's 40% of this 51,000. That's going to equal 30,896. That's going to be less than our salvage value. So we're going to have to just take the difference between these, which is 7,894. And then in the last year, we're not able to depreciate. So now if we see then that the first year depreciation expense is 95,360, but their income before they do that is 88,500, so they are at a loss of 6,860. But then in year 2 you see that they make a profit of net income of 31,284. See in year 4 80,000, and then the whole amount, because there's no depreciation in year 5. Actually, it would be the same. So we see here that it seems like it did. They still made the same amount of profit in total, regardless of which method you used. So even if you're using double declining, it doesn't change the amount of net income that's used. And again, what we do if it's in a partial, if we have something, but it's not for the full year. So on April the 1st, Cyclone Company purchased a trencher for $285,000. The machine is expected to last 5 years, has a salvage value of $40,000. So we're going to, first of all, compute the first year and second year, assuming the company uses straight line. So again, we see here that the cost minus the salvage is 240,000 divided by 5. They're going to have to depreciate 48,000 a year. But notice that they purchased it in April, including April. So April, May, June, July, August, September, October, November, December. So they used it for 9 months. Okay, because they purchased April 1st. So 9 out of 12. So then the annual depreciation expense for the year is, for that portion of the year, is 36,000. And in year 2, they're going to have it the entire year. So it was for 38. But they had purchased it, because they purchased it mid-year, you have to figure out, break it down and figure out, okay, how many months did they have the machine for? It's going to be how we record the different types of journal entries. So Oki Company pays $264,000 for equipment expected to last 4 years and to have a $39,000 salvage value. So we're going to post the different types of entries related to the equipment. So first, Oki paid $22,000 cash for a new component that is expected to increase the machine's productivity. Well, that would be a betterment because it's something that's enhancing the machine. So we would debit equipment for $22,000 because it's adding to the equipment and making it better, and then we would just credit cash for $22,000. Now, number 2, they paid $66,250 for a minor repair that was necessary to keep the machine working well. So maybe it was maintenance or maybe something broke on it, they had to pay. Well, this isn't making the machine better beyond its original capability. This is something that is just something ordinary just to keep it running. So it's an ordinary repair. So then it would be repairs expense debit $62.50, credit cash $62.50. And then finally, number 3 is they paid $14,870 in cash for significant repairs in order to increase the useful life of the equipment from 4 years to 7 years. And so again, that is an extraordinary repair. They're doing that in order to extend the machine's life. So equipment $14,870 debit, credit to cash $14,870. Martinez Company. So Martinez Company owns a building that appears on its prior year balance sheet at its original $572,000 cost, less 429,000 of accumulated depreciation. The building is depreciated on a straight line basis, assuming a 20-year life and no salvage value. During the first week in January of the current calendar year, major structural repairs are completed on the building at a cost of $68,350 cost. The repairs extend the useful life for 5 years beyond the original 20 years that were estimated. So we'll determine the building's age, plant asset age as of the prior year-end balance sheet date, and cost minus the salvage. There's no salvage value. And originally they estimated that it would last 20 years. So each year they're able to depreciate 28,600. And then you want to figure out then for each how old the building is. And so you take the accumulated depreciation we said was 429,000, divide that by the annual depreciation, 28,600. That means that the building is 15 years old. And so then we'll go ahead and prepare the journal entry. So we have building, debit, 68,350, cash, 68,350. And then we'll determine the amount of the book value of the building immediately after the repairs are recorded. So we're going to take the building, which was 640,350, and then minus the accumulated depreciation is the book value after repairs was 211,350. And then we'll record the journal entry for the current year's depreciation. So 21,000. So it would be book value minus the salvage value then is 211,000. Because you're adding the building cost would be the cost of the building initially plus the repair that was made, and then the accumulated depreciation. So that's the book value. So then the new depreciation amount for each year is 211,350 minus none, because there's not any salvage value, divided by, now we said that extended it for 5 more years. So it was a 15-year-old building, so it had 5 years of remaining life. We added 5 more. So now the building has 10 years of remaining life. So divided that by 10, depreciation expense would be 21,350 a year. So depreciation expense, 21,135, and then the accumulated depreciation on the building credit. Disposal of an asset. Dia's company owns a machine that costs 250,000 and has accumulated depreciation of 182,000. Prepare the entry to record a disposal of the machine on January the 1st in each separate situation. So first, the machine needed extensive repairs and it was not worth repairing. So Dia's disposed of the machine, receiving nothing in return. So you have accumulated depreciation on the machine, debit 182,000 because it was a credit here. So in order to make that 0, we will debit. And then the loss on disposal of the machine is 68,000 because that is the difference between the cost of the machine and how much had been depreciated so far. So the loss on disposal machine is 68,000 because that's what the current book value of the machine is. And then if Dia sold the machine for 35,000 in cash, you would debit cash 35,000 because you're receiving cash. Again, there's still a loss because since the selling price is 35,000 is less than the 68,000 book value, there was a loss of 33,000. So loss of disposal on machine is 33,000. And then the accumulated depreciation machine, 182,000. So debit, and then the credit for the cost of the machine was 250. And then they sold the machine for 38 cash. 68. And again, it equals, so there's no gain or loss. So you have cash, 68,000, accumulated depreciation machine, 182,000, and the machine, which is for cost, is 250. And then if they sold it for 80,000, there would have been a gain, or it was still, let's see, since the selling price of 80 is greater than the book value, there's a gain on the machine. There we go. So cash 80,000, accumulated depreciation machine debit 182,000, and then the machine 250, and the gain on sale on the machine is 12. And if you dispose of the asset mid-year, Rhea Company purchased a machine for 105,000 on January 1 of 19. Straight line depreciation is taken each year for 4 years, assuming a 7-year life and no salvage value. The machine is disposed of on July the 1st of 2023 during its 5th year of service, but it's supposed to last 5 years. And so that's the balance of the accumulated depreciation and then the balance of the machine. Again, you see here that you have depreciation expense, and this is for depreciation on July 1 of 2023, because you have it multiplied by half a year. So half of the depreciation for the annual is 7,500, and then credit, so debit to depreciation expense, credit to accumulated depreciation machinery. That adds to the accumulated depreciation. And again, they dispose of it during its 5th year. And if it was sold for 45,500 cash, they receive cash debit 45,500, debit to the accumulated depreciation 67,500. The gain on the sale is 8,000, and then the cost of the machinery was 105,000 credit. But if they sold it for 25, they had a loss on the sale. So they received cash debit 25,000, accumulated depreciation machinery 67,500, loss on sale, so 35,500 book value minus $25,000 selling price is 12,500. Depletion of natural resources, and I don't believe I had one of these on the homework. I'm not sure, but we'll look at it anyway. So Montana Mining Company pays $3,721,000 for an ore deposit containing 1,525,000 tons. The company installs machinery in the mine costing $213,500, which will be abandoned when the ore is completely mined. Montana mines and sells 166,200 of the ore during the year. So we'll prepare the year-end entries to record both the ore deposit depletion and the mining machine redepreciation. Mining machinery depreciation should be in proportion to the mine's depletion. The reason for that is that once the mine has been completely depleted, they're just going to leave the machinery in place. They're not going to take it out. So there's no salvage value, but obviously it would be depending upon how much ore was mined. So you have the cost for this is for the actual mine itself. So 3,721,000. There's not going to be obviously any salvage value. They're going to, when they're done, there won't be any left. And then divided by the total units of capacity in tons. So we know then that the depletion expense for each ton is $2.44 a ton. And so if we take 244 multiplied by 166,200 tons a year, then the depletion expense for the year would be 405,528. So you have depletion expense, mineral deposit, 405,528. Debit, credit to accumulated depreciation, mineral deposit, 405,528. Well, so we've taken care now of the actual mine itself. Now we're going to take care of the machinery that's in the mine. The machinery in the mine costs $213,500. There's not a salvage value. Again, divided by how many tons of ore there are in the mine of 1,525,000 tons. So it would be 14 cents a ton. So again, 14 cents multiplied by 166,200 tons equals 23,265. So depreciation expense on the machinery, debit 23,268, and then accumulated depreciation on the machinery, credit 23,268. Let's look at amortization of intangible assets. The Milano Gallery purchases the copyright on a painting for $418,000 on January the 1st. Now the copyright's good for 10 more years, and the company plans to sell prints for 11 years. So we'll prepare the entries to record the purchase of the copyright on January the 1st and in its annual amortization on December 31st. We have to debit copyright in the amount of $418,000 and then cash credit in the amount of $418,000. And then to figure out the expenses for each year, you're going to take the cost, $418,000, divided by the remaining legal life, which is 10 years. So $41,800 a year is the amortization expense. So amortization expense copyright, debit $41,800, credit the accumulated amortization copyright $41,800. Talk about goodwill. Robertson Company purchased Franklin Company for a price of $2,500,000. The fair market value of the net assets purchased equals $1,800,000. So what amount of goodwill that Robinson records on a purchase date is $700,000. And again, that would be, you would take $2,500,000 and then subtract $1,800,000 from that is $700,000. Now remember that goodwill is not amortized. Instead, Robertson must test the value of goodwill each year. And if the value is impaired, it must be written down. Goodwill is only recorded when it is purchased. Goodwill is not recorded by the company that created it. And so the goodwill would be like the good name of the company and the reputation of the Franklin Company and all of that. But Franklin wouldn't be able to record that or deal with that. It would only be the Robertson Company because they're the ones that purchased it. Determining effective asset use. So the following information is from the annual financial statements of Locke Company. Calculate the total asset turnover for years 2 and 3. So again, remember that the net asset turnover is net sales divided by the average total assets. So in year 3, so it'd be 5,856,480 because that's the net sales in year 3. And then the average total assets would be from years 2 and in year 1. So 1,800,000 plus 1,686,000. You'd add that up, divide it by 2. So we get 5,856,400 divided by 1,743,000. So they're using their assets 3.36 times. And then we can do the same thing in year 2. So year 2, I think they might have these reversed, exchanging assets. So Gilly Construction trades in its old tractor for a new tractor, receiving a $29,000 trade-in allowance and paying the remaining $83,000 in cash. The old tractor had cost $96,000, had accumulated depreciation of $52,500. So we'll answer the following questions, assuming the exchange has commercial substance. So the book value of the tractor is $43,500 because you have the cost of the tractor minus the accumulated depreciation. So first of all, what is the loss on the asset, and then what is the total amount that is debited? So you would debit the new tractor. So you paid $83,000 in cash, and then plus the trade-in value. So the original tractor would have cost, if we would have paid cash for the entire thing, would have been $112,000. And the accumulated depreciation on the old tractor was $52,500. We're going to debit that because initially we credited it, so we want to clear it out. And then we have a loss on the exchange because the old tractor had a $43,500 book value, but we traded it in for $29,000, so we lost $14,500, and then we'll credit the old tractor for $96,000 even, and then we'll go ahead and credit cash $83,800. That's how much we paid. So the loss we figured out was $14,500, and then what amount should have been debited for the asset for the new tractor is $112,000, because that's what it cost, but we paid $83,000 in cash and then $29,000 with the trade-in on the old tractor. The disposal of assets. On January the 2nd of 17, Bearing Company disposes of a machine that cost $44,000 with accumulated depreciation of $24,625. So we'll prepare the entries to record a disposal under each of the following assumptions. So we see here that the book value of this machine is $19,375. So the first one is if the machine was sold for $18,250 in cash, and you notice that would mean that we had a loss. So we received cash debit $18,250, accumulated depreciation machinery $24,625. The loss on sale, so you have the book value, which is $19,375. Subtract $18,250, which was our selling price. We had a loss of $1,125, and then we have to credit machinery $44,000. Now, the machine is traded in for a newer machine having a $60,200 cash price. A $25,000 trade-in allowance is received, and the balance is paid in cash, assuming the asset exchange has commercial substance. So we see here that we actually gained on the exchange. So you have machinery new for $600,200, accumulated depreciation machinery of $24,625, and then you have machinery old $44,000. The gain on the exchange $25,000 less than $19,375 book value is $5,625, and so then we'd also credit cash for the amount that we paid, so the balance. So we paid the new machine cost $60,200, but they gave us a $25,000 trade-in credit. So balance. So we had to pay $35,200. And the machine is traded in for a newer machine having a $60,200 cash price. A $15,000 trade-in allowance is received, and then the balance is paid in cash. Assume that the exchange had commercial substance. So in this case, we see that we had a loss on the exchange because they only gave us 15, but the book value was $19,375. So you would have machinery new debit of $60,200, accumulated depreciation machinery $24,625. Loss on the exchange, again, $19,375 minus the $15,000 trade-in is $4,375 debit. Then you have a credit to the old machinery of $44,000, and then cash $45,200.